More mortgage pain for borrowers. ANZ and the Commonwealth join Westpac in jacking up rates. And a landmark case linking a popular weed killer to cancer opens a floodgate of litigation. ANZ and the Commonwealth became the second and third banks to jack up rates today. Their announcements came within minutes of each other and follow Westpac's rate hike last week. ANZ's variable home loan rates are rising 16 basis points. That's an extra $40 a month on a $400,000 loan. CBA's rates will rise by 15 basis points. Commonwealth customers slugged $37 a month more. Westpac raised its variable rate by 14 basis points last week. ANZ says its 70,000 customers in drought-declared areas will be exempt from the increase. Shane Elliott is CEO of ANZ. I spoke with him at ANZ in Sydney. Shane Elliott, why now? Why today?
Well, it's never an easy decision when you're changing rates because you know it's having an impact on our customers' lives. Really, we've seen this change in the cost of funds.
This is exactly what the CEO of Westpac said. Exactly that. It's never an easy decision. You've got to start that way.
It's kind of our input cost as a bank. It's been on for quite a period of time. We were hopeful that it was going to go back to normal. It hasn't. We've held on for as long as we thought was reasonable. We have to balance the needs of our borrowers with our shareholders and depositors. We meet and we talk about it a lot, and we came to the decision it was the right thing to do.
The right thing to do. Again, that interbanking lending rate has gone up, I think, for now 6 months, and they're just passing on the cost. I'll be on the bank's side this time because they're a business. Unless you want to change the system completely, where banks are not the places to get a mortgage, they've got to cover their costs. They have shareholders and they have depositors. They've, as Elise said, jacked up the rates, and that's just how it is. This is just one of those things that will prick this bubble, in my opinion.
I know that it will be hard for many. I don't know that it's going to see a material rise in the number of people who are doing it tough. If they are, they should call up to the bank and we can see what we can do for them.
Okay, there was something anecdotal that happened at work 2 days ago. I was talking to my colleague, and he said he was in one of those corporate boxes at the one of the football matches, and he said there was a manager from Commonwealth Bank, and he said that they got a whole bunch of people and then transferred these whole bunch of people from a department that used to look after the loans and new loans, and they've actually transferred them into the hardship kind of area, as they're expecting a lot of these calls to come through and claims for hardship, where they're going to have to process those claims and try and get people through this increase in funding rates, mortgage rates, and obviously a drop in property prices. I suppose that you can only revive a patient for so long. Eventually that won't work, in my opinion, because if the rates go up and not down, and if people get into hard times, what else are you going to do? They'll probably say, look, we'll give you 3 or 6 months where you only pay interest, and then people kind of can try and meet their mortgage repayments, and then when they can't do that, they'll say, okay, we'll give you another 6 months, and so on and so forth, but they can only do it for so long. In the meantime, the interest rates are rising, so even the interest rate only payments will probably be too much for too many people. But anyway, that was the anecdotal thing, and this colleague of mine, he doesn't know that I've got this channel. I suppose we didn't reveal any names, but that was interesting. I thought, wow, that actually falls into what we're looking at here, which is documenting the collapse. Really, that's what we're doing here.
Well, you've got rising mortgage rates.
Yes.
You've got wages growth continuing to fall. You've got a household savings ratio at decade lows.
So it probably doesn't going to get any better. I accept that it's hard to see that there's going to be this, continue to get much stronger from here, but it also doesn't mean it's...
Okay, this is funny. I had to replay it.
You've got a household savings ratio at decade lows.
That's funny. And then that was it. She just then says.
So it probably doesn't go.
That was a bit of a moment. All right, we're moving on. I find both of them very animated, very interesting. I really enjoy this interview. I hope you are enjoying it as well.
It's all on.
What effect do you expect this increase in rates to have on house prices?
So that's an interesting question. I mean, there's quite a lot of factors that are happening in the economy today. From just thinking about housing, right? What we know is that, as I mentioned before, the amount of credit that most people can get has gone down. Just because of tighter standards. Quite understandably, because of the changes with the regulation, because of the scrutiny of the Royal Commission, because the banks are trying to do the right thing, we're asking a lot more questions, taking longer for people to get approved, right? Or they have to come with more evidence. All of those things kind of conspire, and pricing for the mortgages going up, all of those things conspire to say that when mum and dad turn up at an auction on a Saturday, they probably have less ability to bid for that house, yeah?
And
for the mortgages going up, all of those things conspire to say that when mum and dad turn up at an auction on a Saturday, they probably have less ability to bid for that house, yeah?
And
for the mortgages going up, all of those things conspire to say that when mum and dad turn up at an auction on a Saturday, they probably have less ability to bid for that house, yeah?
and less
so
competition with fewer investors in there.
Yes, less competition. So probably, that's why we're seeing a softening in house prices. That softening has been pretty gentle to date, and I think that's been a good thing. After a period of sustained house price inflation, it's probably not a bad thing to see them just settle down a little bit.
And
Okay, yeah, the softening. He explained it as softening, and you know what? If you're looking at the percentage falls, it is a softening, but that's exactly how it happened in Ireland, in Spain, in the United States. It actually didn't drop off the cliff straight away, but it did take about maybe 6 to 12 months to actually materialistically materialize itself and show up on the numbers and make a big difference for people who purchased in the last 2, 3, 5 or even 6 or 7 years, where after all the costs, overheads when buying property, they really are even or down under water.
After a period of sustained house price inflation, it's probably not a bad thing to see them just settle down a little bit.
And gentle to date. What about the next couple of months?
We don't know. And there's so many factors at play here, we can't really say.
And given those factors that you've mentioned, Royal Commission, tighter lending standards, more expensive funding for you, less investors in the market, tighter competition for anyone who wants to take out a loan, what does that mean for bank profits?
Well, bank profits have been under pressure recently, and you've seen that, the industry has seen our return on equity, probably the best measure to look at, be on a sustained decline actually for a number of years. And
okay, well, if they didn't make a point as to why the property prices are going to go down, the only question is by how much and how long is it going to take before they materialistically decline. They agreed. In the last 3 minutes of this interview, they've made all the right points. They hit it right. They hit the nail right on the head. I got nothing else to add. Even the CEO of ANZ, one of the big 4 banks in Australia, admits it. He calls it soft. It is soft so far, but that's how it starts, in my humble opinion. And once again, this video and every other video I have, I make some statements. They're my opinions. They're not financial advice. So that goes for all of my videos. It's just a disclaimer. It is something that I'm doing. And again, it's not a financial advice. Thank you. Having said that, another point I'd like to make that I did before, I would not buy banks, bank stock. And also, when I say banks are going to go down, I don't mean they're going to go down and go bankrupt. That's what most people misunderstand, is their share price is going to go down. They're not going to go down out of business. The share price is going to go down. So do you want to buy shares in a company, a stock that's going to go up or down? Well, banks are going down that way. they're not going out of business. All right, but this is not a financial advice. This is just something I'm doing right now.
The industry has seen our return on equity, probably the best measure to look at, be on a sustained decline actually for a number of years. And so we've gone from, as an industry, being in the high teens, down into the low and the mid-teens. So that
your cash profit has continued to rise over
because we've got
the whole bunch of halves.
Yeah, sure, because we've got bigger, because we've got more and more of our shareholders' capital putting out to work and making those loans. But the actual rate of return we're getting on every single one of those loans has come down quite significantly.
Return on equity on every one of those loans has come down significantly. So this is the bit about not buying bank stock.
And you expect that to continue?
I think, on my personal view, it's going to continue because it's getting tougher and tougher. The competition, you point out, absolutely. Whether it's good old-fashioned traditional competition, but also the new competition, the non-banks, there's many people starting up banks wanting to get into this business. That will keep a cap on margins. And just general growth is going to be lower. As we said, with house prices, flat to down, that in itself puts a bit of a cap on the amount of lending that we can do. So I'd say yes. That's why we've said we think the real secret to success as a bank for the next period is going to be the bank who's really good at allocating its capital, really good at managing costs. That's going to be the way that we'll get earnings growth, if at all.
Okay, the narrative continues. It's not getting much better for banks. Watch this.
The National Australia Bank is going to federal court over the fee for no service scandal. The corporate regulator is alleging NAB superannuation trustees, Nulis and MLC nominees wrongly took $100 million in fees from hundreds of thousands of customers without providing services. NAB executives have been interrogated about fees for no service at the Banking Royal Commission, but the regulator is only pursuing civil penalties. Taking a look at the market.
What can I say? That says it all. It's not getting much better for the mortgage holders or banks. So it's just going to go and get worse from here on, in my opinion.
Michael, how did investors react to the news of ANZ and CBA following Westpac with higher rates?
Well, while it's not good news for mortgage holders, clearly it's better news for shareholders. And that's the way the share...
To the news of ANZ and CBA following Westpac with higher rates?
Well, while it's not good news for mortgage holders, clearly it's better news for shareholders. And that's the way the share market reacted today. The whole market was under pressure. We saw a more than 1% drop in the index.
Oh, don't worry. I've got more for you. Here it comes.
More mortgage pain for borrowers, how lack of competition is giving the big banks the upper hand. I'm Carrington Clark, coming up on the program. More mortgage pain for borrowers, how lack of competition is giving the big banks the upper hand. The Prime Minister has joined the chorus of criticism of the banks after 3 of the big 4 raised their home loan rates, despite no move by the Reserve Bank. Scott Morrison says the banks don't realise how angry the public is with them. For people buying a house, not only does the rate rise mean an increase in mortgage repayments, but also the worry it could go up again at any time.
This is another funny thing. The new Australian Prime Minister, Scott Morrison, says banks don't really understand how angry the borrowers are at the banks. You know what? They may be angry at the banks, but it's not the banks. I hate to be defending the banks. What he's trying to hide is how much debt the government has got themselves into and are going to have to pay back. The cost of borrowing around the world is going up, so there's nothing you can do there. But Scott Morrison is blaming banks and using words like angry and that sort of stuff. It is the government that is going to bring this whole system down because they borrowed too much and they spent it into crazy, stupid things. We don't see it. Infrastructure, yes, it's getting a bit better. But they're bringing in so many people into capital cities, Sydney, Melbourne, that they're not keeping up with that. So they're spending all this money. And we know that every dollar that's put in by the government into whatever quote-unquote investment, probably about 70% of it is gobbled up by the shronky business and the inefficiencies and bureaucracy. So you want to lose money, give it to the government.
Paying his home loan is already a struggle for Mark Layton, and now he's worried it'll get even tougher.
Mine will go up nearly $100 a month. So, $1,200 a year, and given that I can't really meet that payment at the moment, it'll